happens when prices are rising? When prices are rising, L mean focus on L, lower income, lower profit gonna be lower taxes gonna be. So it doesn't mean that you're not getting higher profit. It is just the way you are playing numbers game. And it doesn't mean that, okay, you have to sell because this pen, we bought it earlier, so we have to sell this pen first. No, in godowns, in factories, we don't care about the stuff. We just pick that and we sell it. We don't see even dates and all the stuff. We just sell it. It is just number game, playing with numbers, right? So for those, questions, okay, sir, we purchased this, we are selling this pen. So we purchased this pen earlier, so we'll sell this pen earlier. No, costing method. So we take those costs, which is, we purchased earlier. So we're just playing with numbers, not playing with the, physical stuff. So physical stuff's in normal routine is going, materials coming, going out from godown, from store to store, from retail stores, right? It's normal stuff. Everything is going smooth. It is just a number games. So when it is a number game and you apply LiFO, LiFO is resulting low profit, lower taxes. It means increase in cash flow. Cash flow from operation is going to be higher, right? And remember, cash is the blood of any organization. So if higher the cash flow, you have more opportunity to invest in other projects or, do some other expanding or, replace the plant, machineries like that, right? So comparing, I already tell you. So LiFO provides more realistic net income, right? Because LiFO cost of goods sold will be up to date. Income statement going to be up to date, more realistic. And most recent costs are like, so, and if we compare ending inventory, so the balance sheet of FIFO is going to be more up to date because ending inventory is based on recent prices. Now, LiFO and managing reported income. So remember, the LiFO, it allows manipulation of net income. We saw that because, of course, if you want to save taxes, you will apply LiFO, right? So when prices are becoming, increasing, the cost prices or supply or material is going to be increases. So you apply LiFO, you are saving your taxes. So in that case, what's going on? Liquidation can occur. What does it mean? It's a natural business process. When you order material, right, in a factory, some material is damaged or obsolete or expired, right? So it gives you advantage not to categorize or not to fall those, expired material into, wastage or make it expense or just waste that. Because LiFO include previous lower costing techniques. So if a material is, purchased 2 years ago and now it is expired, so you don't delete from your system. You don't basically waste that material. You still keep it with your, maybe physically you throw it, but in your systems, in your number games, you don't do it. Why? Because it gives you benefit. Because whenever you sell, you allow that cost to older numbers which are lower, and you can increase the profit or you can decrease the profit whatsoever, right? So in that case, older layer of inventories is going to be, you keep it, and in that case it gives you disadvantages with realistic purposes. We call this dip into, right? LiFO is not allowed in International Financial Reporting Standard, but it is allowed in GAAP. In order to file taxes, you can make income statement and use LiFO. But you cannot file your income statement to Security and Exchange Commission with LiFO. You have to either average method or either FIFO. LiFO is not allowed. Now here comes, yeah. Now here comes a comparability issue. So in US, I think I should explain this here. So okay, so under the gap principles, right, the LIFO is allowed, but the gap principle related to the inventory, it says that everything should be disclosed, which means if you are using LIFO, you must mention on the income statement that, or on the balance sheet, that these figures that I computed on balance sheet and cost of goods sold on income statement, I calculated using LIFO. The representation and faithfulness, it should be, plus disclosing, plus it should be, sorry guys, I would need, 5 more minutes. I would take you 5 more minutes. So it should be faithfulness. Your actual numbers, don't manipulate that one, and consistency. It doesn't mean that since this is rising inflation environment and you are switching from FIFO to LIFO. No, you need to be very consistent. If you see this kind of stuff that previously they used LIFO and now they are using FIFO, and then again they are using LIFO and next year they are using FIFO, it means clearly they are manipulation. They are in manipulation. They are manipulating the figures. In that case, if it is proved that it is intentionally, then it's a fraudulent activity because you are cooking the books, right? So now question is, so US allow the LIFO and rest of the world, they follow IFRS, they don't allow the LIFO. So in that case, if you see the income statement of these two countries or maybe two companies, two different costing methods, then it's not a comparison. Why? Because you need to compare apple to apple. If one company is using LIFO and other company is using FIFO, then their profits is not comparable, their balance sheets are not comparable, hence their ratio analysis, we learn in finance, profitability ratios, right, they are also not comparable, right? So if you are using LIFO, then please convert the other company's inventory in LIFO as well, so that you can compare, and your comparison going to be on realistic basis. That just I want to explain that one, but normally it makes sense in finance when you're going to understand financial analysis of a company and measuring its health. Okay, now lower cost or market rule. So we know that inventories are recorded on historical costs, on cost basis. So what if we purchase on higher prices and now the market value decreases? So the rule says lower of cost or market rule. So it means if market prices decreases, you purchase at expensive, and now there's a deflationary period running. So the comparison, or when you compare it and the difference, we make it expense, and we say that this is impairment, loss of inventory value due to deflation. Or what if you purchased it earlier, now it's more expensive, buying material is more expensive, then you won't revalue your inventory to upward, you will place it like this because the value is lower, right? So let's read that. So it requires that inventory should be reported on financial statements, whichever is lower. So inventory is historical cost, your purchase value, or the market value. What does it mean by market value? You didn't sell it yet, right? It means what if your inventory, if you can sell right now, how much? Sorry, what if the inventory value, if you purchase right now from the supplier, how much it cost you right now? So that is the market value. We call this generally replacement cost, right? If buying the inventory right now, the same quantity, 52 units, now cost you 3,000. And right now it is, you bought it 52 units of tent a month ago, 2,000, and now you're closing the books. And now what happened? Those 52, if you want to purchase right now, it can be purchased at 3,000. So rule says, do not value your inventory upward. Why? Because there is a chance, there is higher chances that you want to increase your assets, because assets is equal to liability plus owner's equity, and asset inventory is an asset. You want to write down the bigger value so that your assets looks more and your business looks more profitable. Your worth of the business increases, right? Everybody wants to put higher number. The rule says no. You need to compare your actual inventory prices plus its replacement cost. What if you order right now the 52 tents, it costs you 33,000? Don't write 2,000. What if it cost you 1,000 in the market and you write it down 2,000? Then you write it down 1,000, not this 2,000. Okay, this is lower the market value and lower the stuff. So what happens if the market value lower? Simply we call this loss. How we can make the entry? We need to decrease it and we charge it to the goods sold. Simple. So loss of inventory. So previously you bought it for 3,000 and now the market value decreases to 2,000. 1,000 is loss. So we charge the loss to inventory. Inventory decrease 1,000 credit, and we call this difference as a loss. So loss is an expense. Expense mean debit. So debit to credit, which is cost of goods sold to inventory. That's it. So how we represented? So we represented on the balance sheet as inventories lower than 3,000 means it was 3,000 according to our analysis, but due to the market value decreases, so we write it down 2,000, and that difference is added to cost of goods sold to increase the expenses, which means the decrease in the value of ending inventory gonna decrease our profit as well. Why? Because cost is going to be higher. So this is just for your information, and that's it. So this is just for guidelines. I want you to pause the video and read the, we already talked about that, like decision which inventory system to use. So you can just read that. And here, let's go. Which costing method to use is just here. We already talked about that, just for your reference, read that. So that is the end of our lecture. I would be uploading the assignment of inventory. And it's going to be assignment 6, right? Yeah, assignment 6. It's not going to be too big. It's going to be like two questions, that's it, so that you can have more practice. And there are going to be, like more than 30 questions in your book. You can also practice from the book chapter as well. So if there is no more question, then I should end our lecture here. So I apologize for taking your 5 more, extra minutes. Any more question?
Yes, but it's not in regard of this lecture.
Okay, we will talk about after this, after I stop the lecture. Okay, class. So we are going to end our lecture. So remember, the assignment is going to be due on next class, at the beginning of next class. And if you still have any question, you can post on our WeChat group as well. Okay, until then, take care. Bye-bye.